Welcome Freedom Builders, here back to the Building Freedom channel. Today is a stock of the week day. It should have been last Friday, but I had a couple of other videos coming out, so this is a Monday video instead. Sorry for the delay. We're going to look at Lowe's Home Improvement Warehouse today, and that is an interesting stock, especially for those of you maybe that looked for some dividend payouts. First of all, I haven't mentioned it yet, but I am on Facebook as well under Building Freedom. I will put a link to it below. Right now there is mainly videos put in there, but I hope we can get a bit of discussion or some question asked once in a while in there. So remember to sign up there. Also, if you haven't done it already, remember to subscribe to the channel, like the video and all that, so that we can tell the YouTube algorithm that you like to see some of this. Alright, let's get to the video. Those of you new here, I'll just give you a quick overview. When I look at a stock of the week, I look at some of the qualitative fundamentals, meaning all of the stuff that is not just numbers, but all the things surrounding, that could be the macroeconomics or something like that. I'm looking at that. I'm looking at the numbers also, the basic fundamentals, looking at dividends. What are the insiders doing? Where is the price and value? Where's that headed right now? We're looking at some short-term views and of course also looking at the price chart, since I am a technical trader also. So let's have a look at it. First of all, if we look at the chart just quickly, if you remember my strategy, I'm not sure if you've seen the video, but I have a couple of videos under the Learn My Strategy playlist, and some new videos are coming this week. But right now we are in what I call a yellow zone, meaning that we are not at a complete buy yet, but we are close. This one is an RSI indicator, and that should be above 50. That is, we can check that off. But this one is what we call a comparative relative strength. That should be above both of its moving averages. What that tells us is if the stock is doing better than the overall market. And right now it is not. But we are close, and we should not see a lot of increase before it is outpacing the market, and that's what we like to see. So it is close to a green zone, and that is kind of the timing I am using when I find a good stock. I want to see the good stock being in an uptrend as well. I'm not much of a bottom fisher. I've gotten some questions from some of you asking me, well, why didn't you buy at the bottom and so on? But I am not a bottom fisher. A lot of the stocks I buy, they tend to go up 50 or 60 or sometimes 100% before I buy. But if I can find a good value stock that is in a good uptrend, that is what I like to see. So let's see if this is actually a good and solid company. First of all, we are in Stockopedia here, and those of you not knowing that, that is my favorite tool to find the fundamentals with. I'll put a link to it below if you want to check it out. They have a couple of weeks of free trial and a 25% discount if you use the link down here. But they have this score. They have the quality score, the momentum score, and the stock rank. These are the three I'm primarily looking at. The value score is also there, but that is not my favorite here. The quality above 70, as I like to see. The momentum, and that is both momentum in price but also in earnings. So if they have some positive earnings coming out, some positive earnings estimates, some earnings surprises, etc., all of that is put into this momentum indicator. And the overall stock rank should also be above 70, and that is at a very good number here at 81, gone up 9 points over the last 30 days, so it is in a good upwards momentum. The PE ratio, and that is a 12-month forecast PE, it is a bit high, but as you know, I also look at what is expected of earnings per share growth. And when you take the current PE divided by the growth, expected growth of course, you get the PEG ratio, and that should, in my opinion, be below 2, and this is 1.3, and that is great. As you can see, great earnings per share growth. They're really putting an effort in, and already now, if you are a dividend investor, we have around 2% in dividend. That's not the highest dividend in the world, but let's see how it develops. If you are a pure value investor, you might be a bit surprised or a bit frightened about the price to book value here at 38, but I'm not looking too much at that. I'm looking a bit more at the price to sale, which is fair. I also look at the price to free cash flow, which is not great, I must admit, and neither are the enterprise value to EBITDA, but we can address that later. All in all, the quality of the company here, return on capital, return on equity, and operating margins are quite fair. If you take a look down here, what I want to see is a good steady growth in earnings per share. And we can see that. We can also see that in the total revenue here. The operating profit is a bit jumpy here, but earnings per share normalized here is growing quite at a neat speed here. We can see 2019 had a bit of a decline here, but all in all, we have had some good growth rates, and they are expected to continue with a 50% growth rate in 2020. So that looks great. If we look at the cash flow, we have the cash flow here, and I do like to see a steady growth here. Just be aware that the last blue bar here is the trailing 12 month, and I'm not looking too much at that. I'm looking at the actual numbers for ended fiscal years. And we can see a good growth in operating cash flow. There's also growing capital expenditures. We can get back to that in a second, but we can also see a good growth in free cash flow here, not looking at the last TTM bar there. So this also checks out. If we look at the dividends, and as you might know, I'm not really a dividend investor. I do like the dividends, of course, but honestly, it's not my main focus when I invest. But I know many of you are looking to it, so if you can have a look here, now it is a bit squeezed, but we have the dividends per share in the top, dividend growth in percentages, and we have the yield down here in the dividend cover. So let's have a look at it. We get a fair dividend. As you can see, it is expected to reach 2%, but it is growing quite quickly. And what I do like to see is that the dividend cover, meaning how many times the earnings per share is covering the dividend, that is quite fair. It just dropped below 2 here in 2019. I do like to see it above 2, but it has been fairly high, and it is returning to some high numbers here on the estimates, 2.7. So that is absolutely fair enough. I'm not too frightened about that. Also, what I do like to see, and not many people are looking at that, I think, but the free cash flow, what they actually sit on, how much free cash they're sitting with, that one should also cover the dividends per share. And you can see here in 2019, we had a free cash flow of $6.18 per share, and they only paid out dividend of 1.78. So there's plenty of room there to pay the dividend. One thing we should also look at, and that is one of the reasons I think that dividend should not be the only thing to look at. That is because in the later years, of course, money have been put into dividends, but there has also been some huge buyback programs where the companies have bought back some of their own stocks. And that, when you add the buyback percentage to the dividend yield, you get what is called a shareholder yield. And that is actually a bit of, I think that is a more fair measurement of how friendly the company is to shareholders. And if you add these two numbers, meaning the buyback percentage and the dividend percentage, you get a shareholder yield at 6.41%, and that means actually that they are spending twice as much money on buying back their own stocks to, you could say, to keep the price up, or they actually think their own stocks are very good investments. So the dividend yield is okay, but actually the overall shareholder yield is even greater. So almost 6.5%. I think that is great. One of the things, of course, you should look at when you look at a company like Lowe's here is they are having these 2,000 stores, around 2,000 stores where they're selling all this home repair, home maintenance stuff, and sell a lot of branded products as well. They're mainly located in US and Canada. So if you're sitting in Denmark, where I am, or somewhere in Europe, you probably have never heard about Lowe's, and for good reason, because they are primarily in US and Canada. I think they have a couple of stores in Mexico, maybe, but that is the main the main product, or the main countries for their stores are the US and Canada. But 2,000 stores is quite large, and one of their closest competitors, of course, is the Home Depot. That is quite a bit larger. But if we look at their growth rate, we can see that they are actually they're buying a bit of extra companies. They're doing some acquisitions, but it's actually not competitors really they're buying. The last competitors they bought was something called Boomerang Commerce, and that is that's a digital or it was a company that had a digital product that they can use to make their internet, the digital appearance stronger. And that is actually where they're using a lot of money, because as you can see, if we go back to the numbers, they are taking on a lot more debt. And I think from 18 to 19, their debt went up with a couple of $1 billion, and their interest went up. The interest payments went up around 15%. One of the reasons is that they are putting a lot of money into getting a stronger digital presence, and I think it's around $500 million per year they are putting in these years, hiring a lot of engineers and so on, because that has been one of their weak spots. That has been the digital presence, but they are getting a lot stronger there. When I look at the analysis from different sector analysts, they are saying that Lowe's are really getting up to speed on this area. Okay, so if we look at the interest, they are taking on a lot of debt, and of course, the larger the leverage a company has, the more exposed they are to potential hikes in interest. And right now, when we're looking at Fed and the overall market, they're saying that they will keep interests low for a while. But of course, we should be aware that if interest all of a sudden shoots up, that will expose Lowe's to a bit harder times. Right now, we can see that they have an interest coverage at 7.41, which is okay. They can pay the interest. The quick ratio here is not good. If we look at that, it says that the quick ratio is a measure of how many times a company can pay its current liabilities using its cash only. So right now, if they were to pay back their debt, there will not be much cash to pay that with. But in these companies where we have 2,000 stores with a lot of merchandise put in, a huge stock of merchandise, it is not unusual that they have a large debt and that the quick ratio is low. But 0.13 is very low, and that is of course one of the main concerns when I read the different analysts. That is that debt level. All right. One of the things that we should, of course, also look at when they are taking on debt, we can just jump into Guru Focus here, because one of the things you should look at is something called, I know it can sound a bit cryptical, but WACC versus ROIC. Now, what does that mean? Well, this is the WACC is the average cost. The WACC is the average cost they're having when they are borrowing money. So, at what price can they borrow money, and that also includes shareholders and all the costs to money they are taking into the company. And they have a VAC, as I call here, at 8.66%. Now that of course should be compared with how much return on invested capital they can get. So the money they are borrowing, or the money they're taking in from different sources, of course they have to pay interest on that, but we should also compare that to if they can get a good return on these on that money. And if the return on invested capital is, as in this case, twice as large as their average cost on the capital they're taking in, then it is actually okay, because that means that they are growing, and of course they're growing for borrowed money, but they are actually making the money work for them, and that is quite okay. Very good. There are a couple of severe warning signs here, and that is that their gross margin and operating margins has declined. But I was just looking at the estimates, and with all the changes they're making in the organization, it is actually estimated that this will grow pretty much in the next couple of years. So that was it. Now, if you're looking here at SACs, we can see that they have a SAC rank at 2, and that is fairly well. I am looking at 1, 2, or 3s when I am, that's just another quick scan here. SAC rank has quite a good history when you're looking at 1, 2, and 3s, and of course especially 1s and 2s here. They often grow quite a lot in the coming years. They have a good performance track record here. But what I look at here is broker recommendations, and I do like above 2, because that means that brokers are recommending buy or strong buy. And what we can see here is that the average broker on lows, that it has been down at 2.2 in 2017, but then it went up, dropped a bit back, and now it's rising again. And you can see that it is correlating quite well with the price, so that when we see a drop in price, we see sometimes a drop in recommendations. We also see a drop in price, or at least a stagnation in price. And when we see the recommendation, the broker recommendation go up, we also see a rise in price. So right now, the broker recommendations are up at above 1.4, which is great. If we look at the price and earnings surprises here, just a second. We have here, let's load the chart. We can see that over the last year or so, there has been one negative surprise here, and that is okay. Normally, I like all greens, but if we look back the last year, a year and a half, it has been, except this one, has been all positive earnings surprises. So that, of course, leaves the analysts and the investors in a good mood, and they're saying, well, even our positive estimates are met and surpassed. So they have had a long history here of negative earnings surprises. And of course, you can see the price can go up even though there are negative earnings surprises. But I do like to have at least the last year, year and a half with primarily positive earnings surprises. You can also see here that the analysts' consensus as to where the earnings per share will go in the future. If we just load this one, SAC can be a bit slow here, but you can see here we have for 20 and 21, that is the two numbers here, and we have the earnings per share over here, and you can see that the analysts are expecting it to it is a positive bias. They are expecting it to rise. So we do like to see these lines go upwards and not downwards. That usually puts a lot of pressure on the price. Okay, if we go to the shorter term views here, I am at tip ranks right now, and you can see that the low stock analysis shows us it scores an 8 out of 10. And if we look at why, we can see that the analyst's rating right now, the price is at 121.5. If we look at the top analyst, and I'm only looking at the analysts with rankings of 4 or 5 stars, meaning that they're doing quite a lot of good hits. They're really calling some good shots here, and you can see these are actually. Over the last 1 or 2 months, we can see they have come in, buy. There are no sell recommendations here, and they're actually up around 130 to 140 in their estimates. If we look at this one, here, you can see it here that the low end is 130 and the high end is 153. We have out of 14 analysts, we have and that is the best performing analyst. 12 has a buy and 2 has a hold. That correlates nicely out here with the let me see the analyst. Where are we finding that one? Here, analyst consensus on 41 brokers. They are between buy and strong buy, so that is quite nice. If we are taking a look at the other factors here, we have some hedge fund activity that has decreased a bit. The blogger opinion is bullish. Inside activity, there has not really been any inside activity. Only we're at a few $23,000, so that is not really a thing to consider. We can see the new sentiment is very bullish, and we have some technicals and fundamentals are bullish. So an 8 out of 10, that is good enough for me. If we look at the bit longer term value here, and you know that I am using the fast graph here. Let me just remove this. If we look at the historical the historical chart here, you can see that we have, let's just go to adjusted earnings for a second. Comes here. Yeah, you can see that the we have the normal PE ratio here normalized over the last 10 years and then a couple of years into the future. We can see that that is a normal PE at around 20, and a growth rate in the earnings per share at around 16.5%. So that is great. We can also see that the price has just oscillated around this blue line, and of course it is a bit above right now. But there are actually some quite heavy expectations to the next couple of years' earnings here at 18 and 12% in adjusted earnings. So if we go in the forecast mode here, and they have put the expected rise in earnings in here, and you can see there's actually 30 analysts here weighing in, and their average is 18%. There are 21 when we are looking at 2 years, 21 analysts estimating on 12%, and only 2 analysts are giving their bet on 3 years into the future, and they are having 28%. Normally I only look 2 years out, and that can be even vague enough. But if we take this growth and say that it could happen, and we can keep the same, you can see we have the price to earning here at 21. If we can keep that one, we actually see a total performance over the next year or so at around 17.5%. That is including the dividend. If you go out a couple of years here and see that it keeps the price earning, we see a performance per year around between 15 and 16%. So that is actually fair enough. It can also be good just to have a look at what if the price earning drops, what if the something happens in the market, something could happen with the macroeconomics, that we can go into a recession, and since the lows are selling stuff to people that wants to repair their houses and maybe flip their houses, or they are managing some properties. If we are going into a recession somewhere in the next 2 years, that of course could hit those pretty hard, because people tend to spend a bit more on maintaining their houses and buying less houses in a recession. So that of course could put some pressure on the price earning, meaning that some pressure both on the earnings of course, and also on the price that people are willing to pay for a company like this. So let's say it drops over the next 2 years down to this point. We are actually still having around 11% per year over the next 2 years. If it drops down here to the median earnings, we still have almost 6%. If it drops below the line here, we are still above. We are still, I know 0.6% per year is not a large amount, but this is in a case where the expectations are not met at all. We can actually go all the way down here to a price earning at 13.9 compared to 21 right now, and we would still only, quote unquote, lose around 5%. And this is the kind of stock that I like. that even though the expectations are not met at all, we could actually see that we will still not lose the shirt completely. So this one actually looks quite nice, I think. All right, so what is the conclusion here? Well, looking at Lowe's, it is not a it's not a sexy company. It's not like I get a lot of questions about Tesla and some semiconductor producers and all sorts of stuff. Lowe's is just a steady grower. And if we look, as I mentioned, on the dividend, they're growing their dividends quite well, and they have a good. Now, where did we have the dividend? Here. Just a second. Yes. We have the dividend here, and it is growing quite quickly with a nice dividend cover. And as I mentioned in the beginning, when we add the buyback program, the repurchasing of own stocks, we actually get a shareholder value of 6.41%. So they are using a lot of their free cash flow to keep us investors happy. And I must admit that the Lowe's company could get a place in my portfolio. I will keep you updated on my Facebook site, The Building Freedom, but it could get a place both for the dividend, the shareholder yield, and for their steady growth. As I said, there are some macroeconomic factors that could weigh in, and I've tried to search on Google if I could find something about the supply chain, because right now we have the coronavirus running in China primarily, and as you know, a lot of companies are getting some problems in a very near future if China keeps their harbors closed. Pretty much the factories are closed down right now, and if that goes on for 2, 3, 4 weeks more, a lot of Western-based companies could get into some serious trouble because they have the customers to buy the products. They just can't get the products. And I'm not sure a company like Lowe's, I'm not sure where they get their products from, if that is from China or how large a percentage of their supply chains is based on Chinese products. That is something you should really consider in the next months, the next quarters when you are buying a stock. Because in 1 quarter, maybe 2 quarters, we can maybe see some ugly surprises on the expectations to a lot of companies that all of a sudden can't buy the stuff that they need, so they won't have anything to sell to the customers. So the estimates could be lowered quite heavily if China keeps their harbors shut. But when I'm looking at that, I will keep trying to figure out where Lowe's are, how they are exposed to China. But basically, it is a good and solid company. I like the price chart. It could just go into green here, but basically, looking at the weekly chart here over the longer time frame, it just looks very nice. You can see here, way back, they have gone up from a stock at around $20, and now they are at they are at 121, and they could easily go up more, especially with the friendly approach to shareholders, both with dividends and stock repurchasing. So that is pretty much it. I could see myself buying Lowe's in the near future. I just try to figure out the supply chain issues, but basically I think Lowe's could get one of the seats in this quote-unquote 5-year challenge I like to compare my portfolio with. So I have a bit of cash right now, so Lowe's could be one of the companies that I'll be buying. I'll let you know if I buy it for sure. Alright, if you haven't done already, like the channel, subscribe to the channel, like the video and all that stuff, and also have a look into the Facebook page where I'm planning to put some more stuff in shortly. That's all for now. Take care of your money out there. I'll talk to you again soon. Bye for now.